just give you a little bit of background about Rubrik's Asset Management. Rubrik's Asset Management, in many ways, started life back in 2001 as the asset management arm of a private wealth management company set up by a number of ex-Goldman Sachs partners back in 2001 in London. Over time, that business developed, and we eventually spun out to be a standalone operation. Really, that process started in 2012 and finished in 2015. The wealth management business that we were associated with has now been taken over by UBP, so it's now the London arm of UBP. But basically, we've been a standalone business since 2015. I think the important point about that is it gives us some sort of indication of where our background comes from. We're not a benchmarked operated operation. We started out really looking at capital preservation, low volatility models, where internally in that business, we were developing investment processes which would give us strong compound returns with low vol, while the broader business would be outsourcing, convertible arb strategies, private equity, special situations. So really it was our objective internally to create investment models which would actually produce strong compound returns with managing drawdown risk, etc. And I'm not going to go too much into the dynamics of how we manage money today at all, but just talk about how we look at monetary and fiscal policy and the impacts it has. And what we were saying to the guys, over the last few weeks about this talk was to give you a little idea of how we see the world and how we see monetary policy operating, and then how we see fiscal policy operating going forward. So I think it's very important from that perspective then to kind of put into context what we think monetary policy is. Now, I know for certain many people in the industry will disagree strongly with us in terms of how we view the world. But I think what we've really tried to do really over the last 20 years is simplify the process where we can kind of get a handle on basically what financial conditions look like and why that's so important. So James just kind of opens up the presentation here, and we really look forward to, guys, getting your questions and some criticism you might have of the way we see things in terms of how you look at the world. But I think we just give you a bit of an indication at the beginning here of how we see things. And I'm not going to go back to my usual 500 or 600 years of history in monetary policy. If you have the displeasure of having a long meeting with me one-on-one, you might get 500 or 600 years of changing reserve currencies, etc. But really, from a modern perspective, we can kind of see a lot of dynamics happening, and kind of the mid-90s was a key area here where central banks, through the success, obviously, of Paul Volcker, and obviously from that point on with technology and productivity gains, inflation became much less of an issue, and central banks felt a lot more freedom to use monetary policy and interest rates in particular to deal with fluctuations in economic growth, and became very, very heavy-handed, someone could argue, in terms of using those policies to basically day trade what economic conditions were looking like. So you can kind of see here, over the period of time from the 1990s, after pretty much the worst of the 1970s was taken care of by Volcker in the 1980s, we saw a continuous decline in inflation, and on the back of that, we've seen a decline in interest rates. Now, there's lots of exogenous factors that played into this. As I mentioned, technology, productivity growth on the back of that, but also globalization had a big role to play here. But I think what is very important from a monetary policy perspective, when we're thinking about it from a markets perspective, is the amount of debt that we were able to build up over that period of time as interest rates were getting lower and lower, because of course, you can service more and more debt at lower interest rate numbers. And what has happened in many cases is over the last number of decades is the fact that it's actually the debt levels now that are driving interest rates and not the other way around. The fact that the debt levels have grown so substantially over the last number of years really determine where interest rates can go to. So we often hear these people coming out and saying, well, I think, because of QE and whatever, that interest rates are going to go back to 5% or 6% or what have you. Of course, that's absolutely a mathematical impossibility given the scale of the debt outstanding, because of course, if you multiply the debt outstanding by 5% interest rates, everyone will be bankrupt. So I think there's kind of a misunderstanding of people when they look at the bond market in particular, that actually the amount of debt outstanding really determines how high interest rates can get. And of course, the more you drop interest rates through easing of monetary policy, the more you get more debt on top of it, which basically drives interest rates even lower. So that's one of the very important dynamic that's happened over the last number of decades. So the idea that we could even sustain, higher rates for even a minimum amount of time becomes less and less likely. So, of course, because of course, anytime interest rates do go up, you do have this collapse in economic activity because of the overhang of the debt. And then, of course, interest rates have to get lower again, as we've seen over the last 30 years. But in the next slide, I just wanted to go into a very simple concept to kind of explain to people what it is that central banks try to do and what basically monetary policy can do and what its limitations are. And very simply, what basically central banks try to do is either tighten financial conditions or loosen financial conditions in the broadest sense, because of course, moving interest rates is a very, very broad tool. It's not specific at all. It's really about improving financial conditions. So what I mean by financial conditions improving is, as the growth rate maybe starts to slow down, central banks drop interest rates quite aggressively so that real rates are significantly below where the real growth rate is. And if you view a situation where real rates are below the real growth rate, you have a situation where you have loose financial conditions. Then, of course, what happens over time is that basically, real interest rates will start to rise to the point that they get above real growth rates. You have a tightening of financial conditions then, and the central banks would obviously have to react to that, because obviously economic conditions would tighten, growth would slow down, and then they'd loosen financial conditions again. And that really, in a broad term, is all central banks do, is they look at the financial conditions, and when growth starts to slow down, they start to reduce the cost of credit so that financial conditions loosen up. And this is a game that we've been playing for quite a while. And of course, it's a very difficult game to play, partly because you have this lag effect of interest rates. So when growth is going very fast and potentially concerns about inflation are building in the economy, the central banks will start to raise interest rates. And then when interest rates start to go up, financial conditions start to tighten to the point where financial conditions are so tight that growth basically collapses. And the reason why that happens, of course, is because of this lag effect, that the central banks don't know what the equilibrium level of interest rate should be. And traditionally what they do is they tighten financial conditions so much that they didn't realize that actually the situation was deteriorating until it's too late and then growth collapses. So this is the game that central banks have been playing pretty much over the last 30 or 40 years. And it's basically as simple as that. There's nothing more sophisticated or kind of nuanced than that. It really is a pure game at loosening financial conditions so that people can take on more and more debt to basically expand the economy. So it's a very imprecise tool that they've had to use over time. However, one of the side effects of all this is that people start, as we know in history, getting a lot of hubris around their abilities to deal with things. And then they start to go, well, I want monetary conditions to do X, and I want monetary conditions to do Y, specifically in the economy. And that actually just can't happen. The outcomes from these conditions that they create have a lot more to do with the structure of the economy than it has to do with what they are actually doing. And we just added on the next page here, James, some of the recent quotes we've had from some very prominent central bankers, be it Philip Lane, who talks about, how extensive their abilities are to shape the situation, which in some degrees is true. But then Christian Lagarde starts talking about climate change, and Jerome Powell starts talking about, we want to deal with things like minority unemployment rates. I mean, these are things that quite expressly central banks should not be talking about, because these are not things that they can actually deal with. These are the things, the outcomes of the structure of the real economy and the incentives that happen within the real economy, which is not something necessarily that the central banks have any real control over. So there's a real kind of shift in narrative from central banks from being very broad in terms of we just want to loosen to financial conditions, to start talking about areas which, quite frankly, they're not really able to deal with. And if you've got central banks starting to say, I'm going to use monetary policy to help deal with climate change, you're in a very, very difficult predicament in terms of the type of outcomes you might get. And you might get some really bad outcomes on the back of that, because one thing we'll talk about a bit later on is that actually there's a lot of side effects from these tools that they use. But it basically, what we try to do at Rubrics is try to monitor those changing in financial conditions, because from a market's perspective, it's very, very important. Because a lot of times when you look at the financial markets, people are talking about price earnings ratios. They're talking about all these other valuation matrices, where credit spreads should be, what kind of spread should you have over government bonds, etc. These things are really a side effect of what financial conditions are. Financial conditions are very loose. The PE ratio can expand to whatever number you want it to expand to, right? And no matter what bad news you get in the economy, if financial conditions are loose, basically the markets will pretty much ignore any bad news and find the bad news is actually good news. It's then when financial conditions start to tighten that then you'll start seeing, well, the bad news becomes really bad news. So really, in essence, you can get very caught up with valuation matrices and things like that in the markets. But unfortunately, in reality, the financial conditions will determine more about what happens to capital markets than necessarily the valuation matrix will give you any sort of realistic return on markets. So financial conditions are loose, markets will do very well. Financial conditions are tight, markets will do very badly. And it's pretty much as simple as that. If we go to the next page, James, we're just going to talk a little bit here about what these financial conditions do in the real world. And I mentioned before about, how it affects different aspects of our lives. And of course, loose financial conditions, which we see through the QE programs, for example, in the US, and we've seen obviously, this tremendous rise in capital markets and how highly correlated that has been over the last number of years to the financial market. So there's no doubt, by reducing interest rates, by making financial conditions very loose, making credit readily available, certainly in terms of bank reserves, if not bank deposits, we've had a huge drive up in asset prices, which potentially, which we'll talk about in a minute, might have some very negative knock-on impacts ultimately. But there's no question that the central banks are incredibly effective at manufacturing asset bubbles through keeping financial conditions very, very loose. And there's no one that would argue that that is not something that they have been able to do and have done with certain success and tremendous success, some people would say, but I don't like using the word tremendous because then it makes me sound like Donald Trump. So I'll just say some good success by loosening financial conditions and getting capital markets to do very well on the back of that. Now, if we go to the next slide, we'll see, unfortunately, while that upward swinging capital market slide was very, very impressive, what loosening of financial conditions haven't done in the medium and long term is improved our growth outlook. And it's very interesting, we had some of the most dramatic moves in monetary policy history over the last number of decades. And trend growth, again, continues to underperform. And the US having a trend growth now down to 2%, is quite an extraordinary situation where only a couple of decades ago we had trend growth at 4+%. And again, this is the start of people looking at what monetary policy does and doesn't do. And what we haven't been able to do is use monetary policy to create a situation where trend growth actually starts to improve. Because yes, you can get a spout of improvement in growth in a short period of time, mostly driven by credit expansion. But in terms of the ability of the economy unaided to grow faster, we're not actually creating that environment. So we can see the difference here in the growth rates vis-a-vis what happened to the to the capital markets. And again, if we look at the next slide, we can see again other areas where things don't work. And what really has happened over this period of time was that the expansion of the credit that we had under these loose monetary conditions just started to explode upwards, and the knock-on impact of the real economy starts to drag behind quite considerably. And we look at periods of time like back in the 1950s where $1 extra of growth was creating about $4.50. Sorry, $1 extra of debt was creating about $4.50 of growth. That multiplier of credit in the system has now completely collapsed. And some people would argue strongly that actually $1 of extra debt in the system now is actually causing negative growth in the back of that. So we have destroyed basically the marginal benefit of debt in the system now has got much, much lower. So really what we've tried to do is drag GDP up by loosening financial conditions. But what we're really doing in many cases is just dragging debt levels up, because obviously it's cheaper to borrow on loose financial conditions, but it's having a less and less impact on the real economy, which is going to have some significant implications down the road. So we see in the next slide coming through here, while the growth rates are diminishing in terms of the excess credit in the system, we're not seeing the type of outcomes that central banks are telling us that they're going to get, right? So they keep talking about, well, we want inflation to go up, and we're going to, obviously this QE program is going to help inflation. And to be quite honest, we've heard this for a long time. What we've seen is actually in most cases, QE in particular, this bottom-down QE programs that they've had has actually been deflationary, not inflationary. Now that's a long argument, but a lot of what was said back in 2008, 2009 was that all this QE was going to create inflation. We felt very strongly that wasn't going to be the case, that the excess debt in the system would in itself become deflationary, and you might have excess supply, and you'd have, like we saw in China with their not so much QE programs, but debt expansion programs, created massive excess supply of things like steel, which drove steel prices down. I suppose the clearest example of that has really been Shell Oil in the US. Most of the Shell Oil development in the US has been basically done on the back of more and more leverage loans and more high yield debt. And it's very interesting. I started my career back in the early 90s as a commodity trader, and the dynamics of higher prices, more supply, then obviously prices fall because of the excess supply, and then of course they cut supply back, and then it keeps mean reverting. That actually broke. And what happened, we saw quite interestingly post 2011 and going into 14 and 15, when the oil price started to collapse. As oil prices collapsed, because of the debt overhang of a lot of these shale oil companies in the US, they actually had to increase production, not reduce it, to be able to cover its interest payments. And what it actually then did in many ways, that this cheap money that these companies were able to take on was creating a deflationary impact by having lower oil price, not higher oil price in the system. So ultimately, that's what we have seen. And there's lots of other analogies we could give, but really in essence, what we've seen is huge increases in debt, but not huge increases in inflation, long-term inflation. And obviously, there's a lot of factors like demographics, globalization that had a play here, which is far more important factors than actually the central bank give credit for. So I think that those dynamics in terms of what the central bank said would happen certainly haven't happened, and they keep coming back decade after decade now, not even year after year, with the same story. But unfortunately, that story doesn't play out in reality. And of course, one of the real interesting areas here, of course, is as they've increased the amount of money in the system, the velocity of money. So they have not been able to create that kind of environment which potentially you could create inflation, because of course the velocity of money has completely collapsed ever since we started using this excess of debt in the system. Now, there's lots of reasons for this, but ultimately the outcome of this, of course, is the fact that all this money we're pushing to the system is not finding its way into the real economy. And actually, if you look at the velocity of the financial markets, the money in the financial markets, that actual indicator is actually going the opposite direction. That yes, we know this QE is having an impact on the financial markets, but in terms of the M2, the real economy, it's not having an impact at all. So you can push as much money in the system as you like. And this is really, part of this is because of the way the banking system operates, in the sense that if you create QE money, you end up creating reserves in banks. What you're not creating is deposits in banks. And that differential is massively important. And what we've heard actually over the last, even though we've been talking about this for a number of years, what we've heard central banks talking about recently is how to create deposits, how to create loans to real people who put money on deposit, which will create, you know, money in the real economy, which then they will spend and create a real multiplier in the system. If you put money on the reserve of the banks, it basically allows them to just use that to basically play the capital markets and not play the real economy. And this is one of the big outcomes of why the money supply has been collapsing. If we move to the next one, again, you know, you're not seeing the money going into the real economy, and hence we're seeing productivity, as most people be aware, has been falling quite a lot over the last number of decades. And with lower productivity, we've been seeing lower wages. And again, you know, with falling productivity, because as the money pushed into the system isn't being used effectively, it means that this is keeping wages very much subdued. And if wages are subdued, again, it's another impetus to stop inflation from taking off. And I know there's a lot of people, again, talking about inflation coming up now on the back of what they're doing. It's hard to see, with a few examples I'll talk about later, you know, inflation taking off dramatically with large unemployment and wages staying very, very low at the moment. So again, these aspects of the outcomes of monetary policy in the real economy, as opposed to capital markets, is there for all to see. So if we go to the next slide, again, one of the big concerns really has been the declining employment as a percentage of overall population. We keep hearing about Donald Trump talking about the best economy in history. You know, we've had the lowest unemployment rates ever. But of course, the problem here when they talk about the low unemployment rates is the fact that the participation rate that we're seeing in terms of the amount of people participating in the economy it has fallen dramatically, and they haven't come back into the real economy. So rather than unemployment numbers going down just because people are getting jobs, people are leaving the workforce, which is helping drive unemployment numbers down. And we haven't seen a very large increase in that participation rate or population ratio over the last number of years. And that's actually basically meant that, you know, the workforce, there's a lot of unused potential. There's been a lot of slack in the workforce. And it's interesting, the central banks have recently discarded the Phillips curve in terms of the employment versus inflation relationship. But if you look at the wide unemployment levels, not the U3 in the US, for example, but the wider indication of unemployment in the US, like the underemployed number, the U6 number, that's still highly correlated to inflation. So I think the central banks, again, have been looking at the wrong data, and actually there's still quite a high correlation between the underemployed and low wages in the system. So when people say we've had the strongest labor market in history in the US, actually the real data doesn't actually agree with you, because the way the US looks at it, if you haven't looked for a job in 6 weeks, you're no longer included as unemployed, and lots of Americans have left the workforce. So the data actually, if you look underneath the carpet, isn't quite as strong as people have been saying, and actually it still kind of looks very similar to what a Phillips curve should look like. And here's a very, very important graph that we add, is this really demonstrates, I think, to everybody what monetary policy has done and the diminishing returns of monetary policy over the last number of decades. And we're seeing here the improvement that we've seen in the financial assets, which have been tremendous on the left-hand side, versus the improvements we've seen in the real economy on the right-hand side. And, you know, we've been pushing this whole idea of monetary policy, which has been fantastic for asset prices, but actually being mediocre at best for the real economy. So there's been a real kind of issue now where, and this of course has fed into things like inequality and things like that, that they've done a lot, which has benefited obviously the top 5%, because of course if you look at the breakdown of who owns assets, the vast majority of assets are now owned by the top 5%. However, it's not really helping the real economy. And this has basically lent itself to having the kind of political outcomes that we're seeing today. As inequality has risen, so has this divergence in the political outcomes that we've seen. And that if you have a very equal society, history will tell you, you've had a better political outcome. But of course, in the extreme world that we have today, we're having extreme political outcomes, which we're obviously all living through now in the case of what's happening in the US, and of course, what's happening in the UK right now with Brexit. And very understandably, by the way, why we're having that, because of course, a big weight of people have been left behind by this very graph, because the vast majority of people live in the right-hand side of that chart, and a very small amount of people live on the left-hand side. So you can see after a decade post the financial crisis that this has been really a very, very negative outcome for the vast majority of people. And because of that, of course, we're having very negative political outcomes. But of course, it's important to remember that 2008 and these events have very much been not standalone. They're part of a much bigger process that's been going on for the last couple of decades, as I mentioned, since really the mid-1990s, from the Asian crisis, LTCM, the dot-com, the TMT, the housing bubble, et cetera, et cetera, et cetera. All these crises have been a function of this boom-bust cycle. So if you just think about that for 1 second, every time the central banks have tried to tighten financial conditions where they've loosened them up because of a crisis, what we've had is walked right into another financial crisis. And the timing is eerie at the moment. I mean, if you think about it, we've had a crisis now in 2020, yes, from a pandemic, but we were going to have a crisis in 2020 anyway because of the slowdown of the QE program they started in 2019. But think about it, we had a crisis in 20, we had a crisis in the December 18, we had a crisis in January 16, we had a crisis, the taper tantrum in 13 and 14, we had the European banking crisis in 11, 12, we had the financial crisis in 2008. These crises are a function of what monetary policy has done to the real economy. And what you've had is a situation where you've had a crisis, the central banks loosen financial conditions, things get better, then they try and tighten financial conditions like quantitative tightening or tapers, and you had a crisis and then they loosened again and they had a crisis and they loosened. And it's pretty much every 2 years that we've seen the central banks try to put the brakes on, and within days of putting the brakes on, another crisis shows up and they have another excuse for it. And why these crises are happening more and more frequently now is because the fact is what they're doing by loosening financial conditions is creating massive bubbles in the financial markets. The financial markets are becoming larger and larger and larger as a percentage of the underlying economy. So here's a very similar chart, something, by the way, that Warren Buffett would look at a lot and say, well, if the capital markets are the stock market is more than 100% of the real economy, well, then the markets are overvalued. And this is obviously a traditional thing that he would have used quite a lot. And people really look at this and say this is the kind of valuation matrix and it'll just revert. However, if you look at the next chart, I think it's probably one of the most important charts that we've ever shown people to give you an extent of the difficulty that we're in today. So the GDP number, the orange portion of that chart is the real economy. And then if you look at the financial markets on top of that, okay, so the extent in which the size of the financial markets have grown. You see from the 1980s where, we had very much under control. We still had a lot of limits on what banks could do, the type of leverage you could take, except Glass-Steagall Act, etc. And when we got rid of Glass-Steagall throughout the 1980s all the way to 2000s, financial markets have grown. And here's the problem. The real economy is not big enough to deal with the overhang, the weight of the financial markets. If you think, for example, operating earnings have not increased since 2014 in US stock markets, how can they possibly manage to overhang this much assets on it? Do we really need, as we've seen, by the way, with the oil price back in March, you saw the oil price go to negative. And part of the reason for that is the derivative market is multiple times the size of the underlying oil market. very similar to the crisis that we saw in 2008, where housing market collapsed because for every real mortgage that you had $20, for every dollar of real mortgage, you had $20 of bets, CDOs, etc., CDOs cubed, all these other derivative products on that one mortgage. So as you can imagine, the more times you add leverage to the real economy, the more unstable it becomes. So, you know, what we had in the housing mortgage was, if we had 5% losses in the mortgage market, you had a complete wipeout of the whole mortgage game, as it were. So today we're seeing more and more markets, but the financial markets being multiple times the size of the real underlying. We've seen that in oil in March, when oil had to go to minus $11 because people were unwinding some ETFs. We've seen the gold market as well. The derivatives on the price of physical gold is now multiple times. And this makes the markets far, far more unstable. And what we've seen over the last number of years is every time we've had a correction, it's become that bit more violent. That if you think about what happened in 2018, in the month of December, and a little bit, I think, at the end of November, you had a 20% drop in financial markets very, very quickly as financial conditions started to tighten because of the quantitative tightening program. And the ECB was also reducing its QE programs to the point where we had tight financial conditions, markets dropped 20%, and potentially without very fast action, I think it was the 21st, 22nd, when Mnuchin rang Powell on his holidays in Mexico and said, mate, you've got to basically calm the markets down here. We're going to have a complete collapse. So the more leverage you have in the system, the more sensitive we are to even slightly tighter financial conditions. And that's why real yields in the US have not gone above zero pretty much for the last 10 years, because the weight of which these financial assets are weighing on the real economy is absolutely tremendous. And I think that chart alone should really give you food for thought in terms of how can we possibly sustain assets this large vis-a-vis the real economy. It's just not sustainable, and eventually this will topple over on top of the financial markets assets because it is not sustainable. If we go to the next stage here, one of the things now, this is a presentation on its own, but basically we'll just say that there's built-in system failures with monetary policy, right? As we've mentioned, and as you've seen in some of the charts there's diminishing margin returns of debt. In the 1950s, people pretty much borrowed money to buy plant and machinery. We've gone all the way now to the point of people are, and we saw it with the Greek crisis, etc., in 2012 and 13, where people were borrowing money to pay the interest. And this is very much the Minsky idea. And Minsky is probably one of the few economists who does talk about the transition periods. If you talk about most economists and economist ideas, you're looking at different equilibrium moments, etc. What Minsky was saying was, look, you go for a point in time where you're making good investments, basically, to bad investments. There's a definite diminishing margin returns of debt. And central banks are seeing this today. You cannot, even at zero interest rates and negative interest rates, give money to people because they have nothing good to do with it. There isn't good projects to do. There is a diminishing margin return. So when you get the first $100, you have a good project to do. Then you get your next $100, it's slightly worse, slightly worse, slightly worse. And really what central bankers are doing now, and I'll jump quickly to the third one, poor incentive structures. They're incentivizing people to do the wrong thing. So this really has a lot to do with Paul Samuelson, the economist's rational expectations, where central bankers have been quoted, particularly Bernanke over the last number of years, talking about that if we make interest rates negative, people will borrow money and will create economic activity. And that's pretty much the underlying views they've had, pretty much what they've learned from their 1950s professors. What is actually rational for the central bankers to think about is not rational for example, the CEO of Boeing. The CEO of Boeing's rational thing to do was not invest in new planes, but do massive share buybacks. It wasn't rational for General Electric now to produce light bulbs anymore because they can't. They outsource that business. They do share buybacks. So the outcomes in the real economy are very different than what the central bankers predict to happen, because what's rational for the real economy. And if you think about what's happening today, for example, the difference between the amount of defaults and bankruptcies we're seeing today in the real economy vis-a-vis the capital markets. The central bankers have pretty much said to the capital markets, you will not lose money if you invest in me. However, if you invest in the real economy, I can't stop you seeing bankruptcy coming down the line. So what have people done? People have actually invested in the financial markets and not invested into the real economy. And we've seen this, by the way, pretty much growing over the last decade, where we're seeing what a lot of the analysts have said is investment into the financial assets on companies' balance sheets and not into the real company in terms of plant and machinery. And what they mean by financial assets is basically companies have been using their capital to buy back their own shares to make their PE programs look better and better and better. And this is one of the outcomes that we've seen, massive misallocation of capital, that the money is being pushed into the financial assets, but we can see directly by looking at the data, it's not going into the real economy, which then creates a situation where ultimately you get zombification. Now, this is something that we learned about quite dramatically in the 1990s in Japan, where 20% of their businesses basically couldn't pay their way and were borrowing money just to pay interest payments. And we're seeing now in the US, hitting this quarter, the same number of zombie businesses in the US today as we had in Japan in the 1990s. And if you read a lot of the academic research of the 1990s in Japan, a lot of people put at the feet of the reason why Japan was never able to grow quickly enough was because there was too many zombie businesses, that you were creating credit to actually pay off old loans so businesses don't have to claim bankruptcy. And the word they were using was forbearance lending. And we saw a lot of this, by the way, with Italy. We saw the LTM, TLTRO programs, basically giving loans to people who owed you money to roll over the loans, but not creating any new multipliers in the economy. And one of the issues you're seeing in the European banking system now is a lot of forbearance lending as well, which means that money's just basically being kicked down the can and not actually being pushed into the real economy. And that's being a big drag on economic growth. Now, lots of other issues playing into that, again, demographics, globalization, et cetera, but these, from a financial perspective, are big issues. Inequality, massive issues. Unstable capital markets, a big issue. Debt deflation, something that Irving Fisher talked about dramatically, what the damage that debt deflation has. And one of the fears the central bankers have had is that they're worried about the Irving Fisher's 1930s debt deflation. And what they do is they panic every time deflation shows up and they push more credit into the system, which then, of course, creates the inevitable debt deflation becomes more likely, so they have to push more money in. And it's very interesting. If you look at the growth of QE programs, they've been growing exponentially. The first QE1 program was $800 billion back in November 2008. And we've pretty much grown exponentially to the point now where we just did $6 trillion in the last couple of months. And that's the problem. Every time you get involved with these programs, the next program has to be bigger than the previous program. And that's pretty much what we've been seeing over the last couple of decades. And the other issue, of course, here is market concentration. One of the things for people on this call who will be involved with the equity markets, you'll see massive market concentration. But this is absolutely basically the type of thing you see in an environment like this. This is not, explosion. Anyone old enough will remember the expression, the Nifty 50, which is basically the Japanese stock market of the 1990s. And pretty much like we've now got the FANGs. When you get involved with these type of monetary programs, you do get this basic situation where the bigger get bigger and the smaller find it very difficult to compete. So, I mean, this list of issues is quite significant, but I would say strongly that even if Philip Lane was having a lecture with me in Trinity today, he'd be hard pressed to deny the outcomes of excessive monetary policy don't bring these and many other negative outcomes. And this is where the cost benefit analysis comes into it. I mean, Milton Friedman, when he talked about the helicopter money all those years ago, back in the 70s, he didn't really expect these helicopter money to last for decades. The idea was you gave a boost over six-month periods and timelines like that. And of course, in that guise, the short-term hit is usually pretty good. But then, of course, when you get to the medium and long term, these costs start to show up. And that's something, of course, when you go into long periods of excessive monetary policy, these are the kind of outcomes you're going to have. And it's not really the central bankers who should be dealing with the medium to long term. It really should be governments. And one of the ultimate failures, and a gentleman called Stanley Druckenmiller, a very famous fund manager who worked with Soros for years in quantum and has a 30% return on investments over his career, has said the most damaging aspect of monetary policy over the last number of years has actually been to stop governments from doing their job. They've allowed governments to sit on the sidelines and have their internal fights rather than doing the things that need to be done. And that's where we're moving into fiscal policy now. So if you move to the next chart, James, this is where we are now. That basically, as we've known from the central bankers told us, by the way, in October 2019, Powell pretty much openly admitted monetary policy has gone as far as it has been able to go in terms of what's happened. And what's actually happening now is that the impact we're seeing today has been, yes, for the capital markets, has once again being all about monetary policy. But the real impact that we've seen in the real economy over the last number of months has actually been fiscal, not monetary policy. And the central bankers now have made it very clear that their basic game is up and that it's now fiscal that needs to take over the impact. And what fiscal will try to do now, and we'll get to it at the end, is try to keep financial conditions loose, because it's very difficult for monetary policy now to loosen financial conditions, because basically people can't take on any more credit. The only people left to take on credit in the system now are governments. James, do you want to have a word about fiscal now?
Yeah, sure. Yeah, I mean, I think really just following on from that, I think one of the sort of striking things actually about the crisis that we've just seen has been obviously the scale of the stimulus. I think in the US in total, we've seen about $20 trillion across monetary and fiscal. But interestingly enough, I think the fiscal played a big part actually in terms of the market impact. Like, yes, we've spoken a lot about the monetary and what it did, but certainly, the market was from very early on crying out for, for the government to get involved and obviously, sort of enact various different fiscal programs, which they've done, to the tune of about $11 trillion. And obviously, as Steve mentioned, like where that fits into the whole kind of equation is it's sort of trying to prop up the G component of financial conditions. So that's obviously where governments, have played such a very big part. And I think, in the short run, one of the interesting things we've seen is governments at the moment, and certainly whilst we're in the middle of a pandemic, have the political cover to do pretty much whatever they wanted. So in essence, it wasn't necessarily surprising to see the scale of stimulus that we saw from the US, to see the EU, sort of launch this kind of, huge fiscal stimulus program for Europe, given we were in such a difficult situation. So I think that's certainly helped in the short run in terms of, getting everyone together and essentially providing the political cover to sort of enact these big programs. I think, it's obviously no surprise now, though, as we sort of shift onwards about sort of, 6 months from March, we're starting to see fresh calls from the Federal Reserve for more fiscal stimulus. And when you kind of look at what we've seen thus far, it's not necessarily surprising. I mean, one of the surprising things, I suppose you could say, is that actually incomes in aggregate have gone up. This is just looking at the US, but certainly the fiscal programs were effective in at least kind of plugging that gap in the short run of the economy, which is obviously, look, it's certainly helped kind of keep things together throughout this sort of very difficult time. When we actually look at the sort of the theory behind it, there obviously is quite a lot of evidence to suggest that particularly, in a really sort of sharp downturn in a recessionary period, that actually, yes, government spending and aggressive government spending can have quite a big impact. So the fiscal multiplier, as they call it, is actually quite high, i.e. for every dollar of stimulus you get a high return in terms of a dollar of GDP. And it kind of makes sense when you think about it, because, particularly households who, when unemployment is high and households might be sort of liquidity constrained, they have to spend everything they have just to get by. And the same also applies to local governments and things like that. So certainly in the short run, there's clearly a positive impact to be had of these sort of big government programs. I guess the issues kind of then, the issues with fiscal being the sort of the predominant driver, start to really show their heads as you move out of that sort of initial period and you start, talking about the sort of the medium to longer run. And certainly, again, looking at empirical evidence, of course, the degree to which fiscal programs can actually work and in stimulating growth isn't there certainly to the same extent. And look, you've got a lot of different sort of things coming into play, whether or not, to what extent the government sector begins to to crowd out the private sector. You've got politics then certainly begins to play a huge part. We're seeing it right now in the US. I mean, the US is crying out for another fiscal package. It's highly unlikely, in our view, we're going to see it before the election, But so these are the things that will start to crop up in the Eurozone, in Europe. Of course, this fiscal compact was obviously hailed as a game changer, but what's going to happen in 12 months time when the sort of the economies of Europe are still going to be struggling? They're going to need more stimulus. Are the governments going to come together again and sort of enact another huge program, or are there going to be a lot of squabbling between the north, the south, etc.? So the lots of different issues start to come into play, but sort of setting that aside, for us, and I think sort of a lot of what we've sort of been saying throughout this presentation, and Steve has really been building up to, is there's huge structural headwinds, which kind of have come about really over the last 30, 40 years as a result of these policies, which have to be addressed. One of the things, when we look at the credit markets, we're obviously involved in fixed income. One of the striking things we can see is the relative costs of financing for small businesses vis-a-vis big businesses. So we all know that credit spreads have collapsed, that big companies have been able to issue record amounts of debt at really low interest rates, which is great for them. But for small companies, if they need to go to a bank to get a loan, it's not happening. The rates they're being charged are huge. So the sort of the incentives and the difficulties for smaller businesses vis-a-vis huge businesses is massive, and it's a really, really big problem. Small businesses are a massive part of employment and of future growth. So that's, again, a big structural thing that needs to be looked at, that needs to be addressed, that can't simply be solved by just chucking money at a situation. I mean, Steve mentioned as well this misallocation of capital in terms of capital going to the huge, large mega tech corporations, share buybacks being obviously a huge part of that. But there was a very interesting bit of analysis done about a month ago when looking at Apple vis-a-vis the UK economy, and Apple's actually market capitalization is greater than that of the FTSE, which is quite remarkable when you consider how many people Apple employ and how many people are employed at the level of the UK economy, or even the revenue disparity. So there's something not right there. Is it the case that regulation needs to come in to potentially look at the dominance that these tech companies and the influence that these tech companies are having? Is that something that needs to change? Probably does. But again, that's another thing which is not just which is a difficult thing to solve, and again requires a lot more than just simply turning on the sort of the money printing spigot. And of course, look, without going into, it's probably a topic for another day, but certainly the ESG agenda and environmental concerns and climate change are huge, and again something that policy will have to address, as much as sort of central bankers certainly can try and address it by printing more money, or by obviously shifting interest rate policy, as Steve mentioned at the beginning. It's a much bigger question and a much bigger issue that requires a lot more than just really what monetary policy can do. So they're the kind of issues that we're sort of struggling with, and which, like right now, just saying yes, more fiscal spending, whilst it's great in the short run, more fiscal spending isn't going to address these things. They're far more nuanced and probably far more structural, than that, really. Look, this is a bit of a provocative slide we've kind of put in there, but I suppose the point is clear. When you sort of have unfettered access to a printing press, this is actually what can happen. This is obviously the Deutschmark during the Weimar Republic. We all obviously know about the hyperinflation that occurred there when the government was just, the central bank was printing money for the government to pay its reparations for World War I, and then ultimately pay interest rates on the debt. And you can see how very, very quickly, the situation can completely spiral out of control. Now, we're not sitting here saying we're on the brink of this necessarily, But to those people who suggest governments should just simply get access to the printing presses, print money, and spend, on everything, from infrastructure to wages to tax cuts, whatever you want to say. This, unfortunately, is the outcome of that, and we've seen it. This is Germany. We've seen it in other countries as well. In Latin America, if it was as simple as printing money, as we've always said, Venezuela would be the strongest economy in the world, but it's not.
Can I jump in with a question or two, just because I need to hop off the line? And this is for either Steve or James. Firstly, Steve, you talked a little bit about the impact or the lack of impact on inflation as a result of unconventional monetary stimulus continuing to reduce interest rates. James, you talked about the kind of baton being handed over to fiscal stimulus now. Do you think that we will see inflationary pressures come through as a result of fiscal stimulus kicking in now? And then secondly, just how, Steve, you've kind of built up a picture of quite a gloomy outlook, and now with interest rates pretty much zero across the globe, we can't go much further. How do you therefore position a kind of multi-asset class portfolio, or even within the credit space? How do you allocate
Sure.
in such an environment, please?
Okay, so I think very quickly, I was actually smiling to myself as James was talking about massive inflation, as I was talking about deflation. And people will say, it's money printing. Well, it's very different kind of money printing. What I was talking about was basically creating financial reserves, which is very different by buying government bonds, buying financial assets, than actually what James is talking about is putting money into the real economy, creating deposits. So first and foremost, I just want to make the big difference here between the two policies. One is a top-down policy, which is fantastic for the financial markets, but rubbish for the real economy. If you go from the bottom up, you'll have a completely different, where it'll actually be beneficial in the short run anyway for the real economy, but ultimately negative because real yields will go up in the financial assets. So the financial markets, first of all, have to take consideration that this bottom-up approach, which, by the way, currently has been talked about in the US about their policy for loans for the real economy, which I think there's only 8 loans given out under the whole CARES Act. Right, so they put $750 billion to one side to do loans to the real economy, and only 8 companies have actually taken up those loans as of the end of July. I haven't seen the data since then, but I know it hasn't been dramatic. So there's other factors at play here which I think are as significant, first and foremost, which is deglobalization, right? So one of the biggest challenges we're seeing today is actually the deglobalization, where the global economy is definitely splitting in 2, potentially 3, because Europe is sitting in the middle between the US and China. So this US bloc and China bloc politically is going in opposite directions, and that isn't, if Biden hopefully wins the election in November, that dynamic is not going to change anytime soon. If you listen to what the Democrats say, they've actually been more vocal against China than the Republicans have been, pre-Trump. So that dynamic is going to come into play, and that actually, if you think about what could happen then in terms of currency wars, currency has a massive, massive impact on inflation. So if you look at the UK, for example, UK has had significantly higher inflation rates than most of the rest of the Western world ever since 2008, 2009, because it has very aggressively debased its currency and was able to create inflation that way. So inflation, in many ways, if you saw the US dollar rally a lot, that would not be an inflationary indicator for the US. The issue about the fiscal itself creating inflation, it's really it's a measuring tape then. Because what we've seen now in terms of the fiscal, it was replacing the output gap that was lost because of the pandemic, right? This is not actually being stimulus, right? This is replacing lost earnings with, now there, in some cases, yes, maybe a little bit more. But all in all, I would say, and if you look at the analysis that, for example, Goldman Sachs have done, and a lot of other large institutions, they've said that this hasn't been a massive stimulus package as a package that has replaced lost earnings in the real economy. Where the fiscal can become more inflationary is if it becomes a situation where you get growth to be above trend. So financial conditions are very loose and the fiscal is far in excess of what trend growth in the economy is. And that actually hasn't happened yet. So we're already starting to see discussions within the US and even in the UK, for example, where they're going to have to cut back furlonging and all these type of things. And in Ireland as well, Pascal Donoghue has been very active in telling us, guys, we don't have all money that we can spend willy-nilly. And of course, we're well aware of the fact that they start pushing back on excessive fiscal right now, which is the most likely outcome. We're going to have very, very bad economic outcomes. If we don't get a fiscal program in the US, for example, the economic growth in the fourth quarter is going to be horrendous. And because, of course, we know economic growth is now based purely on fiscal, as it was on monetary a number of years ago. So from an investment perspective, the likelihood is financial conditions are going to tighten dramatically in the fourth quarter and the first quarter of next year because of the pullback on the fiscal. So if you look at the overall equation, we're basically looking at a situation now where financial assets are probably going to underperform. And James, if you want to go to that last chart on financial assets here, that basically financial conditions are going to tighten because fiscal will not be enough to replace the lost earnings. It's only when fiscal becomes in extremis of what the trend growth is in the economy at that point in time that we potentially will have the bottom-up approach, creating the dividend, creating the bank deposits. And then, of course, then we'll have an explosion, potentially, of course, in the velocity of money, which will create the thing. My bet is, looking at the markets over the next 3 to 4 years, we're going to be playing with fiscal the same way we played with monetary. So for the last decade, as I mentioned, every 2 years, we had a tightening of monetary conditions till we had a bust, and then they increased monetary stimulus, and then they put on the brakes and they had a bust. We've now put monetary to bed. Monetary is going to be zero rates indefinitely, right? And probably QE indefinitely. There's no more even talk about raising interest rates ever again. That's a busted flush now. That's done. Monetary policy has to stay at its point in time now at zero going forward, as it has in Japan, for example.
Steve, Steve, sorry, I was just going to jump in there and say, we're a little bit...
okay, time-wise, is it?
I just wanted to say, James, do you want to add anything to that in response to Niall's question, or are you happy for me to open the floor? The floor.
I just wanted to make that last point. Sorry, Rory, just quickly to finalize. I know it's dragging on a bit. So basically, going forward now, the way you manage your portfolio is you manage your portfolio against fiscal policy. So if you see there's going to be an increase in fiscal policy, that'll be an improvement in financial conditions, and that'll mean financial assets in general will be doing very well as long as real yields don't rise too high. But when they obviously pull back on the fiscal, then financial conditions will tighten and financial assets will do badly, and vice versa. Now, there's obviously other dynamics there, but in terms of looking at a portfolio management over this next number of years, exactly the same way as we looked at rubrics as monetary policy was, we're looking at fiscal policy now as the big driver. And without fiscal policy, economic growth will disappoint and financial assets will do badly because financial conditions will tighten.
Okay, thanks for that, Steve. In terms of other questions, is there any other questions? I think we've covered quite a lot there. I don't see any questions coming through on the chat box.
And one of the things I'll just add on this particular chart just quickly is the fact that James mentioned it briefly. When you're looking at the R minus G model, which we've been talking about, as in interest rates versus growth and financial conditions, it's growth which is more important than interest rates. Everyone focuses on interest rates and says interest rates are the most important factor for things like credit spreads and equity markets. It's actually ultimately growth. It's not till growth starts disappointing because interest rates are going up that the markets blow up. And this chart shows you going back, we look at this back 50 years, but the analysis for us has always been, it's not the R that matters so much, but it's when R starts to affect the G is when financial conditions start to really tighten. And then that's when you have financial markets underperforming and credit spreads. So every time you see a massive increase in credit spreads, or obviously a drop in the equity markets, is when the G comes under pressure. People worry when interest rates are going up. but actually the markets usually go up on that wall of worry because financial conditions are still loose. The tightening of financial conditions predominantly is impacted by G. So if fiscal isn't there, the G goes down, and that's why financial conditions affect. Even though OR has traditionally been the thing the market's always focused on, you really have to focus on G, and G is credit and fiscal, and credit's basically done, fiscal needs to be there.
Okay, thanks for that, Steve. Well, I guess I think there's a question that's just come in here from Christian, so I'll just okay, so just a question to both, I guess. Is fiscal policy a major growth driver with taxation following suit? James, would you like to have a think about that and come back with your thoughts? Or
I mean, I think, yeah, look, to be honest with you, I suppose we're to an extent we're in uncharted territory. You know, given all of the dynamics, like growth dynamics that are at play, and a lot of the points that, you know, Steve has touched on. You know, we've never seen these debt levels before. For example, you know, we've never been in such a precarious position. So, you know, trying to generate growth any which way is going to be a massive challenge. Again, look.
Sorry, James, can I just jump in there quickly? Sorry, just to give a little bit of history on this. If you look at the example of Abenomics, for example, in Japan, and when they increased the VAT from 5 to 8%, and Abenomics completely failed and collapsed on the back of that. So if you want to know like the impact that increase in taxation to pay for these things can have, you know, you just have to look at that period when, you know, people thought that Japan was starting to get a bit of momentum because of Abenomics, mainly because, of course, the yen collapsed. But it was that dynamic in 2014 where they went from 5 to 8% on the VAT, and the whole thing collapsed. So I mean, it's innocuous, right? 5 to 8% VAT. Most UK and Irish people would love to have 8% VAT. It'd be a huge spurn. So it just goes to show you how sensitive these things can be, that if you even move the smallest amount in a situation like what Japan found itself in, which we're very similar to at the moment, taxation can have a real impact on the growth because it tightened financial conditions and things collapsed. So I think, you know, James is saying it's very hard to put your finger on all these things, but this is why I think, again, from a financial markets management perspective, it's so important to watch these things dramatically. So any of these things can have a big swinging impact. The more the elastic band of the economy is dragged to its absolute limit, as James was mentioning, in terms of the amount of debt in the system, something as small as a 3% VAT increase can snap that elastic band, which is what happened in Japan very, very quickly. So we've got to be very sensitive about the taxation. People are going to worry about obviously paying for all this. And at the moment, the mindset is in the West that we've got to pay for it and that we're going to try to tighten our belts a little bit now. I'm pretty sure by the middle of next year or the end of next year, when we realize that the vaccine isn't enough to get the scars of the real economy gone, that they're going to have to even delve even further into fiscal policy. The same way, by the way, monetary went from, oh, we're just going to do QE on government bonds to negative rates, and now we're buying ETFs, leverage loans, and whatnot. The same way that we thought there was a limit on monetary policy and that they wouldn't go beyond that point, they always did. The same way, every time fiscal policy fails and they have another collapse and they have to reintroduce fiscal policy, that next fiscal policy will have an even bigger bell on the end of it. And of course, very much like what happened monetary policy, fiscal policy has a shelf life.
I think just to add to that, you've also got to consider, you know, the philosophical question, you know, how effective are governments at allocating capital and generating growth? I mean, that's also a big question. So
James, one of the interesting ones for all you Brexit watchers at the moment, and James mentioned very good points about that, and he made a few points earlier on about the $750 billion deal in Europe. What the most interesting aspect of the Brexit negotiations now is why the Brits are willing, and we don't know for a fact, but what it looks like, the Brits are willing to have a no Brexit deal on the back of being able to provide state aid to companies it selects they want to be the big technology winners. that Dominic Cummings has come to this conclusion that we need as a government to support certain companies to being big winners, and they're willing to risk a no deal Brexit exit because of their wanting to actually be so involved in the real economy. Now, my God, is that a flip on its head of what Thatcher was trying to do with the deregulation, the privatization programs for the Tory party? Extraordinary. But I think that really should exemplify to people the dynamics we're at today, where we're literally seeing governments like the UK fight major battles, which could be very costly to them because they want to provide massive state aid. It's an extraordinary world that we live in today.
I just think on that point, Steve, you've made a lot of really interesting observations, and I think it would be quite helpful for those that have attended today that we make some of the information available as well. So certainly I'll make sure to get that information out to everyone. I'm quite conscious of the time here. There is a question which has just come in, and I'll try and answer it. I'll try and ask one of the guys to answer it quite quickly because we've run over a little bit. But in terms of the question, how close are we to genuine credit crisis in the Eurozone? Can somebody give me a quick whistle-stop answer of that one, please?
Not that close yet.
Okay.
By the way, credit crisis equals political crisis, right? So they're one and the same thing. So the credit crisis will happen when we have another major downturn in the economy and we can't have the 27 countries come together and do another deal. That's when you're going to have a credit crisis, when people believe that the political will to stick together falls. And that's when, as we saw with the political will in 11-12 becoming under pressure for the Eurozone, it's actually the political pressure which will create the credit crunch.